Welcome to TechNation, your go-to source for all things technology and business. In today's video, we will be diving into the dot-com bubble of the late 1990s and early 2000s. The dot-com boom saw a surge in technology companies going public and achieving valuations that seemed almost too good to be true. However, as the new millennium approached, it became clear that many of these companies were not profitable, and the bubble began to burst. We will be exploring the factors that led to the dot-com crash, and the lessons that can be learned from it. The term dot-com refers to companies that do business primarily on the internet. These companies, also known as technology or internet companies, began to emerge in the 1990s as the internet was becoming more widely adopted. As more and more people began to use the internet, businesses saw the potential for reaching a global audience and began to shift their operations online. During the late 1990s, the dot-com boom was in full swing. Investors were pouring money into these new companies, driven by the belief that the internet was going to change everything and these companies would be at the forefront of that change. Many of these companies went public, achieving valuations that seemed almost too good to be true. The nasdaq, an index of mostly technology-based companies, reached an all-time high of 5,048 in March 2000. However, as the new millennium approached, it became clear that many of these companies were not profitable. Many of them had never even turned a profit and were burning through cash at a rapid pace. Investors began to lose faith, and the bubble began to burst. Many dot-coms went bankrupt, and their stocks lost value. The nasdaq fell to 1,114 in October 2002, a 78% drop from its peak. The dot-com crash was a result of a combination of factors. One major factor was the overvaluation of these companies. Many had achieved valuations that were not based on their actual earnings, but rather on their potential for growth. Additionally, there was a lot of speculation and hype surrounding these companies, leading to a feeding frenzy of investment. Another factor was the lack of regulation in the industry, which allowed for companies to go public without having to disclose all of their financial information. The dot-com crash had a significant impact on the economy and investors. Many people lost significant amounts of money. However, it also had a positive impact as it led to a more realistic and sustainable approach to internet-based businesses and investments. The dot-com crash of the early 2000s offers several valuable lessons for investors and entrepreneurs. Let's talk about few lessons that we learned from this crash. The dot-com boom was driven by a lot of hype and speculation about the potential of internet-based companies. This led to many companies achieving valuations that were not based on their actual earnings. It's important to be aware of hype and speculation, and to look at the fundamentals of a company before investing. Many investors lost money in the dot-com crash because they didn't do their due diligence and didn't fully understand the financial health of the companies they were investing in. It's important to thoroughly research a company before investing, and to be aware of the risks involved. Many dot-com companies were focused on growth at all costs, and not on creating a sustainable business model. This led to many companies running out of cash and going bankrupt. It's important for companies to have a clear path to profitability, and not to rely on unrealistic projections of future growth. The lack of regulation in the dot-com industry allowed for companies to go public without having to disclose all of their financial information. Adequate regulations can help to protect investors and prevent market manipulation. Many investors were caught up in the short-term excitement of the dot-com boom, and didn't take into account the long-term prospects of these companies. It's important to have a long-term perspective when investing, and not to get caught up in short-term gains. The dot-com crash serves as a reminder that investing in technology-based companies can be risky, and it is crucial to be well-informed, do research and be realistic about the future growth prospects of the companies before investing. That concludes our video on the dot-com bubble and crash. We hope you found it informative and educational. Remember to always do your research and keep a long-term perspective when investing in technology-based companies. Thank you for tuning in to TechNation. We'll be back with more content soon. Stay connected and stay informed.